Now, if you've pulled up this video and you're hoping to learn in a very broad sense about 401ks, then you're in the right place. We're going to talk a lot about 401k contributions, withdrawals, tax optimization, strategies for early retirement, all kinds of different things you can do with your 401k, and how you can optimize the plan for yourself. There isn't a more popular retirement savings vehicle than the 401k. At the end of June of 2023, there were $7.2 trillion in assets in American 401k plans, second only to IRAs, which, as you know, most people when they reach retirement age, they roll their 401k to their IRA anyway. So a lot of IRAs are really just old 401ks. And 401ks get their name from the section of the Internal Revenue Code that governs how the plans are managed. This is also where 403bs, 457s, and thrift savings plans rules are determined. And all of these accounts are very similar in nature, though there are some nuances and differences between each of them. Now, going back and looking at history, employers in the United States used defined benefit plans or traditional pensions to fund employee retirements for years and years and years. But after a while, this became very expensive to do. Eventually, employers wanted to move from a defined benefit plan to a defined contribution plan, or a plan that basically put the retirement saving burden on the employees instead of the employers themselves. Now, in the mid-70s, employers started thinking of creative ways to actually move this burden onto their employees, but there wasn't any legislation to determine how employers went about this process, so in many cases, employees were left at a disadvantage. So in 1978, Congress added Section 401k to the Internal Revenue Code to kind of put some framework and rules around how employers were contributing to employee plans. For the first 2 years, hardly anyone used a 401k. Then in 1981, Congress started allowing employers to make contributions through payroll deduction, and that's when the plans really began to take off. Within the next 2 years, nearly half of all large U.S. corporations had a 401k plan in place or had one in the works. What the 401k did was allow employers to shift a lot of the risk for retirement back into the hands of their employees, while they also got to keep a lot of the tax benefits associated with contributing to employee plans. Now, this marked a major turning point in how we save for retirement in the United States. And if you ask me, it's actually a step in the right direction because it gives us more control over our own retirement instead of having to depend on our employers to do it for us. To begin with, let's talk about two major benefits associated with 401ks. And the first one should be pretty obvious. It's the employer contribution. So if you took all the employer-sponsored 401k plans in the United States and you averaged out the amount they contribute each year to employee plans, that average would be 4.167%. Now, I've heard of plans that match up to 50% of employee contributions, and I've heard of some that don't match anything. Zip, zilch, zero, nada, nothing. If your employer offers a match to a 401k plan, it's probably a good idea to take it. After all, a contribution is basically 100% free money, even if it's only a partial match. That's money you wouldn't have otherwise. The second attractive feature of 401ks is the tax advantages they offer you for your retirement saving. Now, there's two primary ways you can contribute to a 401k. The first and most popular way is on a tax-deferred basis, or pre-tax, or traditional. Those are all things that they're called. Basically, that's when a contribution is taken out of your paycheck before you get it, but it's also taken out before taxes are withheld from the contribution. Those contributions then go into your 401k plan where they grow tax-deferred until retirement, and when you begin making withdrawals in retirement, you then pay income tax on those withdrawals. The other popular option is a Roth contribution, or Roth 401k. And basically, a Roth 401k works the opposite of a traditional. You make contributions after taxes are withheld, but when those contributions go into the account, they can grow completely tax-free for life. So when you take the earnings out in retirement, make withdrawals in retirement, those are completely tax-free. You don't owe any more income tax on those contributions or earnings. We'll talk more about the Roth versus traditional 401k options later, but no matter which one you choose, you're basically allowing the government to subsidize your retirement by using a 401k at all. There is a limit on how much you can contribute to a 401k each year on a pre-tax or Roth basis. In 2024, that's $23,000 if you're under 50. If you're 50 and over, there's a $7,500 catch-up contribution allowing you to contribute up to $30,500 in 2024. In addition to that, if your plan allows, you can contribute up to $69,000 on an after-tax basis if you're under 50. And if you're over 50, that amount is $76,500. To be clear, those after-tax contributions up to $69,000 or $76,500 don't come with any tax benefits initially, but there are some strategies and reasons you might want to do that anyway, which we'll talk about later. And it should also be noted that employer contributions do not count against that $23,000 or $30,500 limit that you can contribute every year on a tax-deferred or Roth basis. Your employer contributions actually go on top of that and don't count against the amount that you can put into it. And within each 401k plan itself, there's a selection of investment options that you can choose from. Plans are generally administered by a financial institution like an investment company. They may collect a fee from the plan sponsor or get their fees out of the expenses that are paid for the investments that are selected by the plan's enrollees. But that brings us to our next point, which is that not all plans are created equal. Now, the basic framework of 401ks is pretty similar because it's established in the law, in the 401k section of the Internal Revenue Code. But beyond that, there's a lot of flexibility in how employers can actually set up the plan. There's a bit of a range where on one end you have employers who set up really great plans for their employees that have lots of investment options. There's a lot of flexibility within the plan. The expenses are pretty low. And then there's the other end, which is like these really terrible, awful, crappy plans where the employer set it up with his golfing buddy or something, and they're expensive and inflexible and archaic, and they're just really terrible. Typically, if you're in a larger company, you'll be on the better end of the spectrum, and smaller companies kind of follow the other. And there's a couple of reasons for that. One is the affordability. If you're a smaller company, it's harder to set up a plan and administer a plan and run a plan anyway. There's also fewer fees for an investment company to collect from the employer or from the plan participants. So they don't tend to focus on them as well as larger plans where there's lots of employees and lots of fees. And the investment company is very interested in keeping that client to basically keep the 401k because it's lucrative for them. Larger companies also will have people who are completely dedicated to employee benefits, whereas smaller companies, it may be somebody's like second or third job, and they just don't have a lot of time to focus on making it great. Now, with that said, there's no such thing as a 401k plan that's set in stone. I've heard lots of success stories over the years of people who have just approached their HR department, be it in small companies, large companies, where there's a feature that's lacking in their 401k plan and they want to see it added or amended or changed. They'll go to these people, and squeaky wheels get greased, guys. Just go to these people, talk to them, ask if it can be added. A lot of times there's no additional charge to have a feature added to a 401k plan. It just takes a little advanced planning, and maybe when you roll over to a new financial year or the new plan year, they can update or upgrade the plan then. If your 401k plan really stinks, I mean it's just terrible, it has expensive investments, the investments don't allow you to diversify very well, there's either no matching or really poor matching, then you might look at opening a traditional IRA instead. That you control completely on your own. There's no matching benefit, but you do completely control the investment choices you make. So there's a lot more flexibility in keeping costs low and actually diversifying your portfolio pretty well. So next, let's talk about 401k withdrawals. Now, Congress set these up so they could be used for retirement. They're not a savings account with a tax advantage just so you can buy a new pool or a new car when you get to your 40s, or a Corvette when you have a midlife crisis, something like that. And to incentivize you to keep the money in the account, there'll be a 10% penalty for any withdrawals you make before age 59 and a half. With that said, there are a few options for actually getting the money out of the account before and after this age we'll go through. The first one is a 401k loan. I'm not going to spend a lot of time here, but you can actually borrow money against your 401k balance if you want to. You have to repay it to yourself, so there's not like a bank or another institution you're really borrowing from. It's from your account, but there are a lot of rules about how you do it. We have another video we've done about 401k loans, which I'll link over my head here. Check it out if you want more details about that. Overall, 401k loans are generally a pretty bad idea. But if you want to know more about them, just watch the video. Another option is to take money out of your 401k for a hardship, things like medical things, natural disasters. I've got those listed on your screen now. Now, the thing about hardships is not all of these actually qualify for a penalty-free withdrawal, and a lot of them you actually have to pay income tax when you make the withdrawal too. So hardship withdrawals aren't all they're cracked up to be. The other weird thing about hardship withdrawals is the plan administrator actually gets to determine whether or not your situation qualifies as a hardship. So even though the IRS has guidelines that set what a hardship is and what it isn't, ultimately the plan will get to determine whether or not your hardship applies. So it's something to keep in mind, but typically if you have a hardship, 401k is probably not the place you want to start to finance that. Our third withdrawal option from your 401k is called the Rule of 55. This allows you to actually begin making withdrawals from your 401k once you reach age 55 years old. Once you retire from that company, you can begin making 401k withdrawals from that plan anytime after you turn age 55. Now, you can't retire at age 53 and then begin doing this at age 55. You can start at age 56, 57, 58 if you want to. Then, of course, at age 59 and a half, all withdrawals are penalty-free. But it's an option if you want to retire a little early, age 55 or later. Keep the Rule of 55 in mind. Another early withdrawal option is 72T distributions, also known as a series of equal periodic payments. And basically, you can start this at any age before 59 and a half. And the way a 72T distribution works is you'll set up a series of equal periodic payments, meaning you're going to pull money out of your 401k each year until you reach age 59 and a half, or until 5 years have elapsed, whichever occurs later. So if you start this at age 53, you've got to run it through age 59 and a half. If you wait and start 72T when you're 56, you'll have to run it until 61, so for 5 years. Now, 72T distributions can be kind of complex and difficult to set up. There's also formulas you use to actually calculate how much you're going to pull out. There's 3 methods. I would reach out to a tax professional to help you calculate that, to assure you don't run awry of any tax laws, because if it counts as an unqualified distribution, you're going to owe a big fat penalty, so make sure you get it right. Now, another distribution option isn't really an optional one. It's called required minimum distributions. And RMDs are a requirement the government places on you as the owner of a tax-deferred retirement account to begin making withdrawals from that account so they can begin collecting income tax out of your account. Typically, the first year RMD is calculated around 4% of the total account balance. You actually determine that by using the IRS's Uniform Lifetime Table, which basically gives you a divisor that you divide into your total balance on December 31st of the previous year, and you'll have until December 31st of the following year to actually withdraw that money from the account to count as your RMD, and you will pay income tax on that withdrawal. There are a couple of ways to avoid RMDs or lessen the impact of RMDs. One is through qualified charitable distributions. We've actually written a post about that on our website, which we'll link in the description below. Another popular way is to convert your traditional balances in 401ks or IRAs into a Roth IRA before you reach the age of required minimum distributions. And what that allows you to do is actually choose when you're going to make that conversion, or choose when you're going to pay the tax. So you could do it in a year where your income taxes are going to be kind of low because maybe you've already retired, you're not working anymore. And so you have a low income, and it gives you an option to go ahead and pay the tax when you're in a low bracket. That way, when you get to RMD age, if you have a large 401k or IRA and you have to pull out an RMD, maybe it won't be quite as large if you can go ahead and convert those amounts before you reach that age. We've also made a video about reducing RMDs, which I'll put a link to above my head here and also in the description below. Now, one caveat to remember is up until 2024, Roth 401ks were also required to take RMDs. People just avoided this by rolling their Roth 401k into a Roth IRA, but you don't have to do that anymore. You can actually leave the money in a Roth 401k now, even after RMD age, and you won't have to take a required minimum distribution for that. Hey, if this video is helpful to you, please click the like and subscribe buttons below so I can keep making content like this to help folks. It really helps our channel to grow, helps us to get the word out and teach people about personal finance. We said earlier we're going to talk about traditional versus Roth 401ks later, and we've reached that time in our video. Now, one of the most hotly contested topics in all of personal finance is whether or not it's more efficient to contribute to a Roth or traditional IRA or 401k. Now, up until 1998, all contributions to 401ks were done on a pre-tax, tax-deferred, or traditional basis, where basically the contributions were tax-free and all withdrawals were taxed at retirement. Beginning in 2006, Roth 401ks were introduced, allowing employees to make contributions to their 401k plans on an after-tax basis, allowing all earnings and withdrawals to be made tax-free in retirement. We don't truthfully have time to unpack this in great detail in this video, but once again, we've made another video, which I'll link above, that covers Roth versus traditional, a lot of the nuances and things that a lot of people don't think about when they consider Roth versus traditional. Now, generally speaking, if you're going to be in a higher tax bracket in retirement when you begin making withdrawals from your retirement plans, then you should contribute to Roth now, because that's going to basically give you tax-free money when you reach retirement age that you can pull out when you're in a higher tax bracket and not get hit and dinged with income taxes quite as much. On the other hand, if you're in a high tax bracket now, you should use traditional or pre-tax contributions, tax-deferred contributions to a 401k, because you're going to take a tax break now, and later on, if you're in a lower bracket, you can make withdrawals then and pay the tax at a lower rate when you're in retirement. Now, none of us really knows what the future tax rates is going to be like. There's a good rule of thumb that if your federal and state combined income tax rate is above 25%, that maybe you should go traditional or pre-tax. And if it's under 25%, maybe go Roth, because the odds are you're going to be in a higher tax bracket later if you're already low now. If you're above 25%, you'll probably be in a lower bracket later. It's really up to you. Personally, I lean toward Roth most of the time anyway, just because it takes all the uncertainty of having the government as my silent partner in my retirement out of the picture. It also gives me some options in retirement to have a tax-free bucket of money, if you will, which leaves a lot of flexibility for pulling money out of different accounts and realizing income from different places. So I have a lot of control over how much income tax I actually realize when I get to retirement and begin making withdrawals. All right, that brings us to some popular 401k hacks. Now, some of these you may have heard of before, some of them you haven't. Some of these may apply to you, some may not. Either way, we just kind of want to bring these up so you're aware of them. The first one is don't outpace your employer when you make contributions to a 401k plan. Your tax-advantaged contributions to a 401k plan in 2024 are limited to $23,000. Now, you may be in a situation where your income's strong enough that you could front load that in the year. After all, the earlier you can invest money, the more time it has to grow. And you might think to yourself, the earlier I get it in, the more benefit I'm going to receive from that money. And that's kind of true. But if your employer is making contributions to the plan, they may do it per check. And if you load all your contributions in the front end of the year, say you contribute everything by June 30th, and so the first 6 months of the year, your 401k has been completely funded by you. If you're not making contributions in the second half of the year, there's no contribution for your employer to match. So you could have outpaced their contribution pace, having already front-loaded everything in the first half of the year. Now, some plans have accounted for this. They're smart enough to know that people do this, but not many do. Most of them, in fact, will warn you. In fact, where I work, they warn us every year, don't front-load these contributions. Make sure you spread them out through the year so you get the full benefit of the employer match. Another popular strategy with 401ks is called the Mega Backdoor Roth IRA or Mega Backdoor Roth. Basically, this is using that space between that $23,000 contribution and that $69,000 after-tax limit. And that gap in between, you can make contributions to your 401k in some plans on an after-tax basis up to that amount. And when you do that, you pay tax on your contribution. So there's no benefit, there's no tax-deferred money there. If you can roll that into a Roth IRA through an in-service distribution, if your plan allows for that, then you can basically mega load a Roth IRA from your 401k using after-tax contributions. Some plans also allow you to convert that money within the plan, those after-tax contributions straight into a Roth 401k. If your plan allows for that, that's a good option too. But it basically gives you a huge volume, a huge space to make contributions to a Roth plan. Another option is to roll your 401k into an IRA really at any point if your plan allows. Again, that's the in-service distribution method we talked about earlier. Now, this is really only necessary if your 401k plan investments either don't offer the diversification that you want for your asset allocation, or the investments are pretty expensive or inflexible, and maybe it's just not as good as your IRA. You could move the money off into an IRA where you have a lot more freedom to select the investments and choose low-cost funds, or maybe put your investments in a certain asset class that you really want to focus on. That's some flexibility you can use there. Another option is to roll your IRA into your 401k. The reason you might want to do that is if you have a high income and you can't make direct contributions to a Roth IRA, you could use a backdoor Roth IRA. And the problem with that is if you have a traditional balance, the IRS taxes you on a pro rata basis for any balances you have in a traditional account or tax-deferred IRA account. And if there's money in there, they're going to tax the whole thing on a pro rata or proportional basis to all of your IRAs. So say if you have 50% of your money in a Roth, 50% of your money in traditional, and you want to make a contribution through a backdoor, well, half that contribution is going to be taxed, and it's going to have to come out of the traditional balance you've already got and move into the Roth IRA through the backdoor method. That's the pro rata rule, and it can sting you if you try to make backdoor Roth contributions. Well, if you take that traditional balance and roll it into your 401k and get it out of an IRA, then it's no longer accounted for in the pro rata calculation, meaning you can make backdoor Roth IRA contributions completely tax-free. Once again, we have another video about backdoor Roth IRAs. I don't know if YouTube will give me another link to put above. If they don't, I'll put it in the description below. Okay, this next strategy is like PhD level strategy for 401k plans. A lot of 401k plans will offer company stock within the plan. It may be at a discount. Usually it's not, because there's a lot of rules around that. And if you've accumulated a lot of company stock within your 401k plan, there's a huge tax savings opportunity through net unrealized appreciation. What net unrealized appreciation allows you to do is take the company stock that you've held within your 401k for a long time, and when you retire, you can move it over into a brokerage account and basically pay capital gains tax, long-term capital gains tax on the sale of that stock instead of paying income tax when you make those withdrawals. Now, the reason that's an advantage is because long-term capital gains rates are always lower than the same income tax rate for that dollar amount. So let's say you're in the 24% tax bracket for income, that's going to leave you in the 15% capital gains rate. So there's a 9% difference in tax when you pay a capital gains tax versus an income tax. So naturally, if you can get that stock into a brokerage account and pay 15% tax instead of 24% tax, you've created quite a bit of tax savings for yourself. Now, there are several rules to using the net unrealized appreciation method. The first is you have to completely sever employment with your employer, be age 59 and a half, be disabled or dead. The second is you'll have 1 year to remove all vested balances from all employer-sponsored plans with that employer, whether they have stock in them or not. And the third is the company stock must be moved in actual shares. You can't liquidate the money in your 401k account or sell the shares within the account, then move the cash over to the brokerage. The shares have to be moved, not money. All right, next is Secure 2.0 changes beginning in 2024. Employer contributions to 401ks can be made on an after-tax or Roth basis. The employee will have to pay any income taxes that are owed for those contributions, but that is a new option that hasn't been available in the past. Another one we said earlier is that you won't be required to take required minimum distributions from a Roth 401k. And finally, beginning in 2025, employers will start enrolling employees automatically into 401k plans to encourage participation and saving for retirement. I don't remember exactly what percentage of income is withheld initially. I think it's like 4 or 5%, and it increases at 1% each year until it caps out at 15%. Now, you can't opt out of this. You don't have to make contributions to the 401k, but if you don't opt out with your employer, they'll begin doing this in 2025, whether you ask them to or not. There are two other nuances I want to talk about with 401k plans. The first has to do with highly compensated employees. Basically, there are restrictions on the amounts that highly compensated employees, which I'll get to defining that in a second, how much they can contribute to a 401k in a given year. Now, there are two IRS definitions to a highly compensated employee. In 2024, a highly compensated employee is anyone who makes more than $155,000 in salary. The other is anyone who owns more than 5% of the company. Now, in addition to that, your employer can actually classify you as a highly compensated employee if you're in the top 20% of income earners at your company. Now, the reason this is important is because highly compensated employees are not allowed to contribute more than 2% of the average of all other employee contributions to a 401k plan in the company. So, if the average contribution amount of salary for everyone in the company is 8%, then highly compensated employees cannot contribute more than 10% of their income into their 401k plans. The trouble is you don't really know what that average is until the end of the year, right? So if you contribute too much to the 401k, you're a highly compensated employee and didn't realize it, usually you'll just get a check in the mail one day refunding you the amount that you've contributed to the 401k with income taxes withheld. Now, if you're in a safe harbor 401k plan, then this highly compensated employee rule doesn't apply to you. If you're in a larger plan, that's probably a safe harbor plan. Another easy way to tell is if your plan has a vesting schedule. In other words, if employer contributions take years to vest based on your number of years of service that you have to the company, then it's not a safe harbor plan. If your employer contributions vest immediately when they're put into your account, then it's probably a safe harbor plan. The last thing I have to say about 401ks is legal protection. Typically, 401ks enjoy a higher degree of legal protection than IRAs. I'm not going to get into the details at all because I'm not an attorney and it varies from state to state anyway, but just know that normally speaking, generally speaking, a 401k will be protected more legally than an IRA. That may or may not be an issue to you at all. If you have a big umbrella policy to protect you from things like that, I wouldn't sweat it, but it's just something to know. So that's nearly everything you could ever want to know about a 401k plan. Now, there's a lot of things that aren't in here because the thing about 401ks is they are so drastically different from plan to plan. There is an endless number of ways plans can be written and managed. So it really depends on your situation whether or not some of the things apply to you or not. The most important document for you as a 401k plan participant is called the Summary Plan Description. Get a copy of this, read it. It has all the details about all these things, about what's available, what's not. It should tell you everything you need about your 401k plan. And if it doesn't, then ask somebody. Find out. Ask questions. Now, as a reminder, we have tons of videos on our channel about 401ks, IRAs, HSAs, Roths, traditional, the FIRE movement, financial independence in general, just you name it. Check out markmoney.com also is our website. We have tons of posts about this information, which we'll link some in the description below. And don't forget, if you like this video, please click like below. Also, if you would subscribe, that helps our channel to grow a ton. As always, we're grateful for your interest in our video. God bless and take care.